In this section we'll be discussing Chapter 2, and we'll only be discussing some of the more salient slides in this PowerPoint presentation, and I recommend that you review all the PowerPoint slides that are listed in Blackboard. So in Chapter 2 we'll kind of get into some of the details of the front end of Form 1040, and we'll be introducing some of the changes to this tax form as well that have resulted from the 2017 Tax Cuts and Jobs Act. So the tax return then is the basic 1040. So the 1040A and 1040EZ, the simpler forms, are now gone, and in their place we have the basic Form 1040 with schedules to accommodate additional tax issues for taxpayers. We still have the adjusted gross income, which really is an important number on the tax return because it impacts the extent to which we might qualify for later itemized deductions if we do decide to itemize as opposed to take the standard deduction. And then also the AGI number, or adjusted gross income number, impacts the extent to which we may qualify for some tax credits. In Chapter 1 we had the very basic tax formula. In this chapter we'll be expanding on that formula, filling in some of the details behind it. Fundamentally it doesn't change, but we do add more detail here. And we start with adjusted gross income. Now we're going to deduct any permitted deductions from gross income, and we arrive at that all-important AGI number. And then we'll take out either the standard deduction or the itemized deductions. We no longer deduct exemptions because at least until 2025 we are no longer permitted a personal exemption, but the standard deductions have gone up considerably. Once we determine our taxable income, we'll multiply that by the appropriate rates or look in the tax table if our taxable income is below $100,000, and we'll determine our tax liability. Once the tax liability is determined, we'll deduct any tax credits, add on any other taxes that we owe, and then we'll deduct finally any tax payments and refundable credits. And the tax payments often come for earned income in the form of withholding during the year from our paychecks. And then if turns out our tax liability is greater than the amount we've put in adjusted for other taxes and tax credits, then we will owe money in, and if the amount we've paid in adjusted for other taxes and credits is greater than our tax liability, we'll have a refund. 5 filing statuses for taxpayers on the individual Form 1040. If the taxpayer is not married as of the last day of the year, then they can file singly, or they would file as a single individual. Married filing joint must be legally married on the last day of the year. What determines marital status is a matter of state law. And of course it doesn't matter if one spouse has income and the other does not. They can still file jointly. But in order to get the advantage of married filing jointly, you must file that way. If you file separately, married filing separately, the married couple, of course, both have to agree to this, and one taxpayer, one spouse, cannot take the standard deduction while the other one itemizes. They both must do the same. So if one taxpayer takes a standard deduction, the other taxpayer filing separately must do so too, and both taxpayers must show the Social Security number and the name of the other spouse on each return. In most cases, you will pay the most taxes if you are married filing separately, so it is usually disadvantageous to file that way. Another tax filing status is head of household, and this too, of course, is determined at the end of the year. If a married taxpayer is living apart from the spouse during the last 6 months of the year, then they might qualify as unmarried, or they might qualify as unmarried. You have to be a U.S. citizen or resident, and must maintain a household for yourself and a qualifying person for more than half the year. So for one exception, of course, is that parents can live in a separate household. This comes up sometimes if you have a parent, for example, who's living in assisted living or in a nursing home, and you're paying more than half their support, very likely you'd be able to claim head of household status. Another filing status that's very similar to married filing joint is a qualifying widow or widower. And so in the 2 years after the death of the spouse, assuming that the surviving spouse is caring for a dependent child or providing more than half their support, they can file for this preferred married filing, or I should say this widower or widow status, which is, like I said, very similar to married filing joint. So in terms of determining dependents, taxpayers may have related individuals living with them. As I said before, they may be living apart, living separate in certain cases. But whether or not we have dependents is really important in determining any child credits that might be available for those under 17, our filing status, and many other tax issues. So to be a dependent, then, the dependent must be either a qualifying child or a qualifying relative. So the dependent taxpayer, there are tests that we have to meet then, and one test is that the dependent cannot be claimed by someone else, right? So the taxpayer can only be claimed by one individual. And then the joint return test, a person claimed as dependent cannot file a joint return with his or her spouse, but there is an exception to this, and that is that if you claim a married couple, you can claim a married couple as dependents and they can file their own return if the only reason for filing that return is to claim a refund and they owe no tax. So only in that event can you claim them as dependents and permit them to file their own return. Must be U.S. citizen as well, a resident or national. If you live in Canada or Mexico, you are considered a U.S. citizen for purposes of this citizen or residence test. Can be an adopted child of the taxpayer as well. So what is a qualifying child then? Well, a qualifying child has to pass several tests: relationship test, age test, residency test, support, and special test for qualifying child of more than one taxpayer. So the other way to become a dependent of someone else is to be a qualifying relative, but to be a qualifying relative you must meet 4 other tests, and one is not a qualifying child test. You cannot be both a qualifying child and a qualifying relative. You must pass a relationship or member of household tests. The gross income of the qualifying relative cannot be more than $4,150. The PowerPoints from the authors have not yet been updated, so they still say $4,050. It's actually $4,150. And then to be a qualifying relative, you must pass the support test as well. So the new standard deductions as of the beginning of 2018 are a single $12,000 standard deduction, double that for married filing joint and qualifying widower, and then married filing separately only $12,000 for each taxpayer, and then head of household is $18,000, which is 1.5 times the single rate. There can be adjustments to the standard deduction. It can increase for people who are age 65 or older or blind. So if a taxpayer can be claimed as a dependent by another taxpayer, then the standard deduction is limited to either $1,050 or the taxpayer's earned income plus $350. And that would be the higher of those two. And the reason they have this provision is so if a person has a child who is a dependent, they may earn, for example, a small amount of money working a part-time job, or they'd only get a refund if they filed. And so if their income is so small that it's the greater of $1,050 or their earned income plus $350, then the taxpayer can be claimed as a dependent and still qualify for the taxpayer for the standard deduction. These are some adjustments then that we can make to the standard deduction for people who are 65 or older or blind, and the adjustments went up this year. If you're single and over 65, you'll get an additional $1,600 on top of the $12,000 for the standard deduction. So $13,600 then. If you're married filing joint, you only get a $1,300 increase on that $24,000 for married filing joint, or $25,300. Married filing separately, limit is $1,300 additional for the standard deduction on top of the $12,000, and then head of household an additional $1,600 if your taxpayer is either 65 or older or blind, on top of the standard deduction for head of household. And then the qualifying widow or widower is very similar to the married filing jointly, so you can add $1,300 onto the $24,000 for a qualifying widower. So the amount of tax liability then is computed, we alluded to this in chapter 1, either by using the tax tables for folks who have taxable income below $100,000, or using the tax rate schedules and calculating that, as I demonstrated last week. The tax payments and credits, as seen in the formula, reduce then the tax liability, because we get credit for credits, of course, and we get credits for the amount we've paid in, or for example had withheld from our paychecks. Some tax credits are refundable, can create a refund, and others are non-refundable, that is, they cannot create a refund. And we'll talk more about this in chapter 9. And then there are certain penalties that taxpayers are subject to for a variety of reasons. One, for example, is if the taxpayers fail to file a tax return. Failing to file is a 5% per month, up to a maximum of 25%. And then any income tax return not filed within 60 days of the due date is subject to a minimum penalty of the lesser of 210, or the amount of tax that is due. Another penalty is a failure to pay the tax penalty. So if your taxpayer is penalized and they don't pay the tax penalty, they'll pay 0.5% per month, up to a maximum of 25%. And then I encourage you to read their other penalties as well, like accuracy related penalty. I encourage you to read and study those penalties in the chapter as well. If you have any questions on these or other topics in chapter 2, feel free to contact